Hi, I'm Pattu from FreeFinCal. Today, let's talk about the benefits of portfolio rebalancing. Now, portfolio rebalancing, when we look at it, sounds very simple. I mean, you start with an asset allocation of, let's say, 50% equity and 50% fixed income. A year or so later, it deviates significantly, let's say by at least 5%, 55% equity and 45% fixed income. You remove 5% from your equity holdings and push it into fixed income to reset the asset allocation. That's all. That's on paper. That's all rebalancing is. But many people make a big deal about it, and they say that they are scared of rebalancing. They don't understand what it is. They're worried about taxes and so on. So I want to talk about what is the real benefit of portfolio rebalancing by looking at some back tests. Now, what is necessary for portfolio rebalancing? First of all, you should have a proper financial plan, and everybody will have a portfolio, but that portfolio should be well defined. It should have only minimal asset classes. If you buy every new product that you see, and you say you suffer from shiny object syndrome and buy every new product, then you cannot rebalance. You will have like 25 mutual funds, you will have some real estate, you will have gold, you will have some InvITs, you will have some rights. Then it will be a complete mess. You must have a minimal portfolio, and only then you can actually think of rebalancing. So the first step is to have a financial plan and to restrict ourselves to a minimal portfolio. There will always be some nice products coming after we start investing. Doesn't mean we can. It's the same thing as forgive the analogy, but it's the same thing as marriage, right? I mean, you get married, and then you're always going to find some other person who you are more attracted to in different ways. But that should remain on theory, and you have to focus on your marriage, and that's how a portfolio should be. Otherwise, it will become too difficult to get to manage. So with that said, what I'm going to do is I'm going to look at about 131 15-year back tests of Nifty 500 and 50% of Nifty 500 and 50% of a simple fixed income with like 6% annual return. So constant fixed income, and I've drawn a back test of this, and these are the results. And you can see here the black line refers to results when you don't do an annual rebalance. The red line is with an annual rebalance. The duration is 15 years, and there are 131 data points in each of those colored lines, and the asset allocation is 50-50. So if you notice here, rebalancing does not give you much of a return benefit. The return benefit is sometimes it's a little bit higher than the black line, but typically it is not higher. That's fine. But look at the maximum drawdown. So suppose your portfolio hits about let's say it becomes 5 lakh, and then because of some market downturn it starts falling. This maximum drawdown is the maximum fall during that 15-year run. So you can see without rebalancing, the maximum fall is 47%, 48%, 40%, and it just keeps, the black line is, this is the black line. But if you rebalance it, you can see that this kind of squiggles is because of the rebalancing, and you can see the rebalancing reduces the maximum drawdown by 15 to sometimes at least 15% roughly, in 10 to 15%, and that's a big deal. So the fall from the peak is reduced because you're doing a rebalance, you're resetting the portfolio. And this is the fluctuation of the portfolio value on a month-on-month basis, and that's the standard deviation. The standard deviation is without rebalancing is high. The fluctuations are very high, but with rebalancing, it's again about 10%, 15% lower. Again, there's a benefit there. Even without a crash, even on a normal market time, there is a benefit in rebalancing. Also, when there is this maximum drawdown, how long? Or not just maximum drawdown, whenever there is a drawdown, there is a fall from the peak, how long the portfolio was below the peak, that is how long the portfolio was underwater. You can see Without rebalancing, the portfolio was underwater for many months, 30 months here, 25 months here, and so on. But with rebalancing, it's much lower. Again, almost sometimes a year lower or something like that. So those are the benefits of rebalancing. You get lower volatility, you get lower drawdowns, the recovery is faster. So don't worry about the returns. I'm now talking about rebalancing between Nifty 500 and cash. That is simple fixed income like a fixed deposit. If you were to replace the fixed income with gilts, if you take a long-term gilt fund, then you have a very different story. I had already talked about how when there is a large negative return in equity, there is typically a positive return in gilt and vice versa. So when you are replacing the fixed income with the gilts, then you are actually, in addition to getting the maximum drawdown benefit, in fact, I think it's a little bit higher here. The maximum drawdown benefit is lower, the standard deviation is lower, the maximum number of months the portfolio is underwater is lower. Also, the returns with the rebalancing is also generally higher. Typically, it tends to be higher, and it cannot happen all the time, but typically it's higher, and that's more than good enough. So these are the benefits of rebalancing. This is why you should consider portfolio rebalancing, but for that you need to first have a proper financial plan. You should have an asset allocation. You should decide how you are going to vary this asset allocation, and most important, you should have an asset allocation or a portfolio, I should say, that is minimalistic. If it has too many products, then it's going to be a real pain to keep track of all of them and rebalance, because you have to review each of them, rebalance, worry about capital loss gains. It's going to be a headache. So don't worry about taxes, don't worry about exit loads. Have a proper asset allocation and rebalance once a year, every year. Bye bye.